Hello everyone and welcome to the channel Law for Citizens. Before we get started, I'm going to do a quick introduction on tax law and then we will get into the discussion of the subject. This video aims to create awareness about tax law, various taxation laws in India, and which helps LLB students to get good score in the exam. It also aims at providing sections and different cases which helps lawyers to revive the sections and outcome of cases. Download the resources in the link below for further studies. So the agenda is we will discuss on the Income Tax Act 1961 and then we will discuss on the wealth tax. So what is meant by wealth tax and how it is paid. So in the Income Tax Act we will discuss on various income schemes and under which heads those incomes are tagged to and what are all the various deductions and what is the net income and finally how much taxable he is so that we will calculate it. And then we will discuss on the indirect taxes, which is the central sales tax and the value added tax. And then we will discuss more sections on the general sales tax 1957 and finally on the GST. So now currently in 2007 government has introduced the GST. We will discuss various items in that. Welcome to the session.
From the income they earn and the properties they have and the businesses they carry out. So simple meaning of the tax is any money we pay to the government in support of for carrying out the government functions, government levy on the people, and the income they derive from the businesses, the income they derive from the property. All these things is called taxes. If you see taxes, there are two types of taxes. One is direct taxes and another is indirect taxes. Direct taxes is it is imposed on a person. So as a person, you are directly liable to pay to the government on your name. Example is income tax. Wealth tax. You are like the cost of goods itself, the cost of items, whatever provisions we are buying, tax is already involved. So whoever is manufacturing, that person will pay the tax to the government. So this is collected indirectly on the consumption. So example for that is GST and state VAT tax. These are all the indirect taxes. So now we are going to cover the direct taxes. Direct taxes is Income Tax Act 1961. So first and foremost important thing is covered and asked in your exams are important definitions. What is agricultural income? Who is called assessee? What is an assessment year? What is a capital asset? What is the long-term capital gain? What is a short-term capital gain? These kind of important definitions repetitively they are asking. So I will cover according to second chapter. You see the important definitions of Income Tax Act.
Yeah.
After that, we will get into residential status. So first is the definition of agriculture income. It is going as per the alphabetical order. Agriculture income is any rent or income derived from the land situated in India. Here the key word is rent or revenue derived from the land, and that land is situated in India. Also, by carrying out the agricultural activity, or sometimes we may give the sublease to some person. So that person is conducting the cultivation activity. So if any rent is received from that subleasing and by the act of cultivation is also called the agricultural income. And
yes, Swati madam, you can also refer the page number, madam. So
okay, it is in the page number 5 of your Principles of Taxation book. Sections and all, I am not mentioning it because you may not be able to remember all these things. So just maybe while preparing personally, please remember the sections also. So easy to remember is agricultural. It is the first definition. All the definitions in any act, it starts with the section 2. So section 2, 1A is the agricultural income. So any rent or income received derived from the land, and that land is situated in India and carried out the agricultural purposes. And even performance of a cultivation, even if it is subleasing also, like a receiver of rent, and that rent is received because of the cultivation carried out by some other person, and by sale of that cultivated product, all these things are coming under the agriculture income. And also if any building is situated in that land, and if that land, that building is also used for the agricultural purpose, and if that rent is received even from that building, is also treated as the agricultural income. So here key points: land, revenue, rent received from the agricultural purpose. Now let us go into the second definition. In the Income Tax Act, person is called the assessee. Please remember, this word is more useful. You should not write anywhere person, assessee. You and me, whoever is paying income tax to the government, we are the assessees to the government. So assessee means any person. So you must be knowing the definition of a person. Person means individual, then HUF, then a company, then association of persons, a cooperative society, any charitable trust. All these things are covered as a person. So assessee is a person by whom any tax or any other sum of money is payable under this Income Tax Act. He is called a assessee. Not only payable, even if assumed to be paid, like sometimes what happens, we think that we are not liable for the Income Tax Act, so we don't pay the income tax, but we are liable to pay the Income Tax Act because of some provisions under the Income Tax Act. In that case also, we are all called assessees. So we need not pay the income tax even if we are liable by any reason, or even if any default is there to income tax department. Even all these cases also, we are treat the person as the assessee. So here we need to remember three words for the assessee. One is person by whom any tax is payable under this act. Also, any proceedings under this income tax has taken place on this person, he is also an assessee. And even if he is deemed as an assessee under any provisions of this act, sometimes deemed, why the term deemed is used, maybe your son or daughter is in some other country, maybe in US, and they earn some income here, and you are representing them and you are filing their returns on their behalf of. So all these cases, you are a deemed assessee. So person who is a deemed assessee is also called as assessee. And even in case of default also, you are liable to pay income tax, but you didn't pay the income tax, you didn't even apply the PAN card. Even that case also, you are an assessee. So these three terminology, please remember. Then next is the assessment year. When tax is payable, immediately the moment we earn the income, whether we are liable to pay the income tax? No. It will take a time. Entire cumulative period of 12 months is taken as an assessment year. So if we take April to March, April 2024 to March 2025, this 12 months period is called the assessment year. For that entire assessment year, income of a person is calculated, then he or she will pay the tax to the income tax department. We pay quarterly, all those things are there, but when calculation of the income takes place, it will take place only for the assessment year. So assessment year starts from April of the financial year. So it's a 12 months period. Next is the capital asset. This is also one of the important definition, and I think many times this is also asked in your exam. So what is the capital asset? So always we term asset as the properties. So please remember the word property. So property held by an assessee, whether or not connected in business or profession. Why it is called business or profession here is, you may be holding a property but you are in the process of real estate business. In that case, that is not your property, that is your goods, like it is a stock in your business. So any property held by an assessee, whether or not connected with his business or profession, or even FIIs, you must be knowing whoever is actively involved in the stock market, foreign institutional investors, if they buy the stocks from Indian government also, that is also called a property asset. So capital asset is involved, property of any kind held by assessee, whether or not related to his business, and securities held by the FIIs. These two are the capital assets. Then next is the long-term capital asset and short-term capital asset. Here the definition of long-term capital asset is given in the negative sense. Asset which is not the short-term capital asset is the long-term capital asset. Then we must learn then what is the short-term capital asset. Shall I share my this thing, sir, the Word document?
Yeah, sure, madam. Sure, madam. I will and share. Yeah.
To see my Word document, sir?
No, madam, it's not loaded. You need to click that arrow mark button, present now, and select.
Yes, I got it.
Yeah, okay.
Now you are able to see, right?
Yeah, it's loading up. Yes.
So
Yeah, I could
far
able to
we have
see.
seen the definition of agricultural income, assessee.
Little bit zoom in, madam, so that font will be a little bit big.
Okay.
Yeah. Yeah.
Is
Okay.
it fine, sir?
Yeah, very clear. Yes.
Okay, sir. I'll not write. Just you see, just for revision purpose, I am writing whatever we have covered. So assessment is 12 months, starting from April. The next what we have seen is capital asset. It's a property and securities by FIIs. Next is the long-term capital. LTCA is long-term capital asset. Not a short-term capital asset is termed as long-term capital asset. Then let us see what is short-term capital asset. If anything, if you are not holding for more than 36 months, that asset is called the short-term capital asset. Not more than the 36 months. So that is called the short-term capital asset. So long-term capital, if by selling long-term capital asset, if we make any gain, that is called LTCG, long-term capital gain. By selling the short-term capital asset, if we make the gain, that is called short-term capital gain, STCG. So better short-term capital asset, there are so many exceptions to this. Usually 36 months period is taken as a holistic broad term. But when it comes to even stocks and mutual funds, at least you should hold it for your book is having lot of big definitions for that. So please see the relevance in your exam. If it is required, please remember that. Otherwise, in simple terminology, remember 36 months. If the assessee is not holding the asset for not more than 36 months, that asset is called short-term capital asset. For that, lot of exceptions are there, like shares and all. If you are not holding for 12 months, then it is called short-term capital gain, short-term capital asset. Even mutual funds also, that you have to see. Then next is the important another this thing is how you are liable for an income tax. One is you should get the income. Second is your residential status. This is one of the most important definition. All of you have to remember this. Residential status. Simply earning income will not attract the income tax. It depends on your residential status. All of you must be aware. We know only two terms. One is resident, non-resident. But for income tax, this definition is much broader. Even if you are resident, also resident and non-resident. Within the resident, there are two terms you need to remember. Ordinarily resident, not ordinary. Why I am writing is you should not forget this terminology. At least if you go once in a while, if you revise this terminology, you can write something in the exam. So one is you have to get the income. Second is whether you are liable to pay income on the India is depending on your residential status. Okay, you are resident or non-resident. If you are resident, again two more classifications are available within that. One is ordinarily resident, another is not ordinarily resident. Who is ordinary resident is here. If you see the last previous year, example for deriving your residential status for the year 2024-25, in the year 2023 to 24, if you stayed in India for 182 days, then you are an ordinary resident. Or even out of last 4 years, because here the intention of the income tax department is they have to get the income. Example, your son or daughter went to the US last year, maybe 2023 May. So by this definition, 182 days they didn't stay in India, so they are not resident. No, you cannot say that. One more provision is there. In the last 4 years, they have stayed in India for 365 days. And in the last year, if they stayed in India for 60 days, then also they are ordinarily resident and they are liable to pay the tax. This much broad definition is given. Also, two more conditions are available in this. If he is resident 2 out of 10 years, these points are very important. You are getting lot of questions in this.
Yeah, I think the case study is also coming.
Yes, sir. So resident 2 out of 10 previous years. Then 730 days or more during the 7 years preceding the relevant previous year. So definition is very broad in this. Any of these conditions, if he is not satisfying, then not ordinarily resident.
Okay.
So they are resident, but not ordinarily resident. Then next is the non-resident. So for non-resident, who is not a resident, he will become the non-resident. Maybe any case law, if it is available, just let me tell. I think in page 18, one example is there. X, a European stayed about 25 years in India. X returned to Europe on 29th January 2011. Later, X returned to India on 2nd June 2013 to join a European company as its overseas branch manager. Determine his residential status for the assessment year 2014-15. See, always assessment year will be the next financial year. For the example, here I will write in the assessment year. Financial year is 2023-24. Assessment year is always 2024-25. Now we are in the financial year 2024-25. For this assessment year will be 2025-26. Why it is next year? Because this 12 months income, whatever we earned in 2023-24 will be assessed in the year 2024-25. So after completion of March only, our employer will issue the Form 16 and our business accounts, we will close it and we will calculate how much profit we earned. So all these things take place in the assessment year. Same way now current financial year is 2024-25. Whereas for this year income, whatever we earn, assessment will take place. The written filing, all these things will take place in the assessment year 2025-26. So in this question, they asked the assessment year 2014-15. That means 2013-14 is the financial year. Is it clear?
Yeah, clear, madam, clear. Always the next year will be the assessment year.
Yes. So here issue is whether X is a resident and ordinarily resident. So if you see the calculation in 13-14, how many days he stayed in India? It is readily given in your book. So he is there in India for 274 days. Right? So he's satisfying 182 days or more condition. Also, he was stayed in India for 25 years. So if he sees he is resident in India for 2 out of 10 previous years. So more than 2 years he is in India. So in any case, he will be the resident and ordinarily resident for the previous year 2013-14. And also he stayed in India for 730 days during 7 years. So all these conditions Mr. X is satisfied. Got it?
Yeah, so here all the conditions satisfy only ordinary resident?
No. Any condition it satisfies.
Okay.
Any condition. Everywhere R is written.
Okay.
Previous year 182 days are 4 years. Out of 4 years, if he stayed in 365 days and last year 60 days also, he is a resident. Then in to be ordinary resident, again he has to be in India as a resident 2 years out of 10 years. And he stayed in India for 730 days. See, condition, previous year, this, wait, I will write here 1 and 2 conditions are for the resident. Okay. If 1 or 2 condition, if he is satisfied, he will become the resident. Once he becomes the resident, next is whether he is ordinary resident. 2 conditions. First is you have to find out whether he is resident. Second is once he is, how he will become a resident? By satisfying any of the conditions mentioned in 1 or 2. Condition. This color code of red is for satisfying ordinary resident. Once he will become the resident only, whether he will become ordinary resident or not will be satisfied by the conditions highlighted in the red color. If he is not resident, you need not go into the conditions told in the red mark. Got it?
Yeah, yes, madam. So, what is the benefit of being a resident and which is more beneficial for that?
No. Once I will become ordinary resident only, whatever incomes even he earns in the foreign country, if he has not paid the tax, he is liable to pay the tax in India. If the person is not a resident, he is coming as a visitor and he stayed here for 6 months, 182 days he stayed, but he will not become a ordinary resident, then he need not pay the taxes. Mr. X has come as a tourist. He liked India. He came to roam every state of India and he stayed for more than 182 days. Simply by this, he will not liable to pay the tax to the government because he stayed in India for more than 182 days. Maybe he is becoming resident, but he is not satisfying any of the two conditions, like a residential status of 2 years out of 10 or 730 days in the last 7 years.
Okay.
This is for whether why it is so important is whether he is liable to pay tax to the government of India as per the Income Tax Act. Simply by becoming a resident, one cannot cannot become liable to pay the income tax. Simply your son or daughter is earning some income in America, they need not pay the taxes simply by staying here for 6 months if they are not satisfying ordinary resident. That's why if 1 and 2 conditions are satisfied, then conditions mentioned in this red color are important, whether to pay the tax to government. So this alone you remember these 4 points. Okay. That's why I made it in the bold.
Okay, madam. Yeah.
Okay. Now, when a person is liable to tax, one is page number 20. Go to the page number 20. He has to see the residential status of the person. Then, if we calculate the income as per the Income Tax Act, his gross income and net income should fall in the income tax slab. After how the net income will come? After claiming the deductions available in the income tax. Next. These are also important. 4th point is also important because as a normal person, if your age is below 60 years, if your annual income is 5 lakhs, you are liable to pay the tax. But if you are a person more than 80 years, then for that 5 lakhs, you will not pay the income tax. So that's why your age is important. Even if it is female, some additional benefits are available. Even depending on the rate of tax, like capital gains taxes are different. So if all these conditions are satisfied, also next important is different heads of income. So if all these 5 conditions are satisfied, only one is liable to pay the tax. One is they have to pass the residential status test. Then their gross income should be as per the income tax liable to pay. After this, they have, certain deductions are allowed and certain rate of taxes, and depending on their age and depending on their sex and depending on the which source of income they earn, then only income tax is charged. Then I will ask one simple question just so that you can remember very well all these heads of income. How in this group each one of you are earning the income? I will list it down. Anyone can volunteer and tell how you are earning your income. Any income.
By working as a manager.
Okay, so you are an employee, right?
Yeah.
Yes. Next, how different incomes are earned by a person?
Rented income, business.
Next,
Trade.
sorry,
Trading.
Next,
Whether FD and mutual fund will cover under this one.
okay, I'm writing FD interest. Next.
Capital gains.
Next. Okay, enough. I will write it. So employee. So by employment, what we get? We get the salary. So it is income under the head salaries. So this is governed by the rules, regulations of income under the head salaries. Rent. Somebody told they are getting rent. This is called house property. They are giving as a rental income. Business. Next, trading. Somebody told that. Okay. Even capital gains, trading, sale of properties. This is called capital gains. FD interest. If nothing is fitting in the above four, like our savings account earning some interest, maybe we get what is that, dividend income. So all this will come in income from other sources. So if you are thorough in all these 5 heads, that's it. So next, what you are going to study is each and every head you have to study. What is salary? Why salary is chargeable to tax? If every amount is chargeable, if any deduction is available for us from the salary, how much salary if employer pays, that is treated as salary income. So in the broader sense, these are all the 5. Just you remember these names. So just I will write the. Now let us start with the page number 20. So next, let us go to the heads of income. In that heads of income, 5 different, page number 24, it is given. Even sections are so mentioned in that. Next, let us go to the, okay, sections I will write here. 15 to 17. 22 to 27. 28 to 44. Next is 56 to 50. So any income one person is earning should fit into any of these 5 classifications. So for each and every classifications, there are sections are there, and that section will tell us how to calculate the income, how to calculate that gross income, how to calculate the net income. After that, what is the applicable tax rate we will see, and we will arrive the what is the income tax is to be paid to income tax department. Now let us get into salary. Page number 31. Income from salary.
Ma'am, I have got a doubt. The services will come under which?
Business
Both
and
the 5?
profession. Business or profession.
Yeah, thank you.
Business or services. Okay. Now let us get into income from salary. Sir told he is working as a manager and he is earning the salary. So what is the relationship you are having with your company, sir?
Manager.
So in the legal terminology, we can take it as a employee relationship. Why this is important is you have some case studies also on this. So one person is earning income from certain company. So he wanted to show it as a salary income, but department wanted to show it as a business income. So how to prove that? If they both have employer-employee relationship, that must be treated as a salary income. So first condition is employer and employee relationship. Then what is covered in the salary? Basic salary.
Allowances.
Allowances, very good. Next, sir.
PF.
Okay. Whatever you are telling, I will write it so that it will go and fit into the correct provisions. Okay. Next.
Yeah.
What else, sir?
Special allowance that comes under allowance.
Okay. Next.
Rental HRA.
Yes. Very good. Next, sir.
Gratuity.
Okay. Next.
That is all my company is giving, madam. Any other give?
Any medical facility?
Medical, yeah, medical allowance.
Medical insurance.
Insurance allowance.
And then if you are going on tour, are you getting any TADA?
LTA, yeah.
LTA. Next. You must be getting some leave encashment. If somebody is working in some government services, they get the pension. Then you may be getting your annual bonus from your employer.
Correct.
Then some companies, they may give some transportation allowance.
Yes.
Some companies, what they give, like if somebody is working in the police department and all, they get the quarters. Outside, if they take the house, it will be more rent. But if they get the quarters from their department, police department, it is at a cheaper rate. So that is called perquisite. Some benefits we get the indirect. It is not in the form of cash benefit, but we get the benefit in the form of concessional rent, home for rent. Then sometimes we may get some, some interest-free loans from your employer. So these are all called you are not getting the benefit in the form of cash, but still you are getting the benefit. These are all called the perquisites. Then one more term is there, profits in lieu of salary. So this I will explain it later. This too I will explain it later. So whatever is the salary, whatever is the allowances, special allowances, whatever we are getting, everything is treated as the salary. And also, what is the salary, whatever received, and due also. And even if you get in the future, like some people, they resign from the company. After 6 months in the settlement process, they may get some additional amount because of the services they rendered in the past. So whatever in the form of salary, whatever you received, sometimes what happens if employer is in a difficult situation, he may not be paying you salary on time, but your salary is in due. In that case also, you are liable to pay the tax on that salary income, though you have not received even. So that is why I have written the term as the due. And because of some resignation, something VRS, if you take, and in future after retirement also, like after coming out of the service also, you may get some sort of money in the form of salary for few months. So everything is treated as the salary.
Okay.
So you will receive in future what you will receive as the arrears. So arrears is also salary. So what is the important terminology you need to remember in this topic is employer-employer relationship is a very important relationship. Then only that income, whatever is we are receiving, can be treated as the salary income. And whatever salary we are receiving, it is taxable salary. Then we will discuss about the allowances and other elements in the salary, one after the other. If sometimes what happens, we may forego our salary, like people in the government service, what they do last 6 months of retirement, maybe we have utilized government facilities, so I don't want my salary. Or sometimes what will happen, some employee will declare, I wanted to give my salary to CM relief fund. It doesn't mean that he's not taking the salary, doesn't mean that he's not liable to pay the tax, because he's earning, he's surrendering, he's foregoing his salary. But if he's surrendering, like some cases, some legal issue, something, and he's not receiving, in that case it is not treated as the salary. But if foregoing because of some personal reasons, I don't want salary, but he is receiving and he's diverting it to some CM relief fund or PM relief fund, in that case it is the foregoing of salary. In that case also one is liable to pay the tax. So salary includes all these things, even pension also. I think we have written pension, right? Pension, all these things. Now let us go into page number 35. Here very clear definition of salary is given. Open the page number 35, because writing all these things is not possible. So I'm just explaining one after the other. So what is salary? If you see your pay slip, there is a basic pay is there. And if one is retired, he will get the pension. If it is annuity, means instead of monthly, maybe they will pay yearly. That is also salary component. Bonus, and some people working in the sales and all, if they meet the target, they may get some additional commission. But because of employee relationship, you are getting that money. Even that commission is also treated as the salary. If any arrears, if any advance salary, everything is treated as the salary. And gratuity, leave encashment, these pensions are all, some exemptions are there. Like gratuity, if you worked in a company for 5 years and you are resigning and you are joining in some other company, that company will pay you as a gratuity. That is also taxable. But if you go in depth into the Income Tax Act, once in a lifetime, that gratuity you can claim as the exemption up to 20 lakhs amount. Like now people are changing the job like anything. If you change 5-6 jobs in your entire career, if you are receiving gratuity from 5-6 employers, one of the employer, maybe at the end the tenure of your service, you can claim as the exemption. But not every gratuity you cannot claim as the exemption. And even leave encashment also. If 300 days, up to 300 days at the time of retirement, as a one time, you can claim as the exemption. Then some other exemptions are also available. I think HRA, it is already written in this. HRA is also, to some extent, it is exempted. And some other allowances like children education allowance, per month 2,000 is per child is exempted. And some hostel subsidy to children also. So all these allowances are exempted from the tax. It will show in the, from your salary, it will be calculated, and as a deduction you will get a certain amount as a deduction, so you can arrive your net salary, taxable salary. Then point C is value of perquisites or profits in addition to or in lieu of salary. This I will explain. Then employer's contribution to PF in excess of 12% salary. As per PF Act, employer is liable to pay 12% of your basic as the employer provident fund contribution. But employer is so nice person and he is paying, no, I wanted to make my employees happy, I am paying 20% of basic as the PF contribution. Only 12% is allowed in the law. So remaining 8%, what it will happen? It will be treated as salary in your hands and you are liable to pay the tax. And if, earlier, like a lot of people used to take advantage of this provision and they used to put lot of amount in the PF. So government has put a provision. If your annual contribution to PF is more than 2.5 lakhs, then that additional amount is also, and that interest earned on that in additional contribution is also treated as the salary. So that's why point E is written here. So all these things put together, it will become your gross salary. Then point G, government is allowed some relief to salaried employee, because every penny earned by a salaried person is traceable, because employer will pay the salary in the form of account, like it will be directly credited to your account, and employer is having complete set of your records, payroll records, so there is no scope for tax evasion. So it is very easy to catch hold of the employees. So to give some relief to them, every year whatever is, suppose our income from salary is 10 lakhs, standard deduction of 50,000 is allowed in the G provision. So that deduction is there, and some employment tax, like every state government, wherever you are working, you have to pay some amount to the as a professional tax. So that professional tax is also that will be paid by the employer, but that is given as a exemption from deduction from the salary. So by deducting column G amount, we will get the net income chargeable under the head salaries. I hope up to this it is clear.
Yeah, yes, madam. Yes.
Any doubts? Because just you understand, whatever you are earning from the employer is treated as the salary. Some exemptions are available like HRA, some allowances. So that is deducted. By deducting this and by deducting the standard deduction given in the point G, one can arrive the income chargeable under the head salaries. Now let us go into the perquisites. Actually, page 36, 37, these rates and all are very old rates. Page 39 also 2023-24 rates are there. One can compute, they can use these rates for computation of the salary. I told you earlier, when one person is liable to tax, attaining certain age criteria, 80 years. If you see here, senior citizen is there in the page 39. If who is the 60 years, then he is senior citizen. Super senior citizen is 80 years. If you see their tax rates are different. Like senior citizen, 3 to 5 lakhs, he need to pay some tax. But for super senior citizen, up to 5 lakhs, there is no tax. So that way, differentiation is there in the Income Tax Act. That's why sex is also important and age of the person is also important. Then even surcharges are there. Like if your income is more than, if your income is crossing 50 lakhs from the salary, then you are liable to pay additional 10% surcharge on your income. So all these things are rates are there, but every rate is not just you see while solving the questions if it is useful. You take the rates, but from income tax website also, whatever is rates are applicable in the current financial year, that you take it. It is available in the income tax site for all these categories.
Okay.
So here points to remember is employer-employee relationship, salary paid, salary due, salary advance, everything is liable to be tax. And the gratuity, all these things are also pension, everything is taxable, subject to some allowances we will get as a deduction under section 10. And if employer contribution is more than 12% in the PF, that is also chargeable as the tax. Excess only, not entire amount, more than 12% fees contributing. Come to page number 48. So here also again definition of salary is given. Salary includes wages, any annuity or pension, any gratuity, any fee, commission, perquisites or profits in lieu of or in addition to any salary or wages, any advance salary, any payment received by an employee in respect of any period of leave not availed by him, means leave encashment. Page number 48, 1.9.1 definition of salary. Please remember this definition. What is salary? So first we will calculate the gross income, gross salary. From gross salary, we will do the deductions and we will arrive the net salary. Next is the important thing, page number 52. In the previous, this income from salary point 2, we have written some allowances, special allowances, HRA. So that we will discuss here. So what is allowance? Allowance is given by employer to meet a specific expenditure. So what are all the allowances usually we get in the salary is? Important thing is HRA. Why HRA is paid? Employee is taking the accommodation on rent. That's why he is getting the HRA. Because employee is taking the accommodation on rent, certain exemption is allowed. So here important thing to remember is rent. If you are, why I am telling rent is, if you are staying in your own home, own house, employer may be paying you HRA allowance. Because you are staying on your own residence owned by you, you are not eligible to claim the HRA exemption. So you must be on the rent to claim this exemption. So this is the most important condition. So people, whoever is employee, whoever is staying in his own residence, he is not eligible to claim the HRA exemption. He may get the HRA. There is no, because employer, as per your package, you are supposed to get certain amount. So he is dividing into different heads. One of the head is HRA he will give. So to get the exemption, you need to stay in the rented accommodation. And certain times, if employee is not incurring, actually, this is very difficult. Point B in the page number 53. If you see, first point A is residential accommodation occupied by assessee is owned by him. So in that case, HRA exemption he cannot claim. Point B is assessee has not actually incurred expenditure on payment of rent by whatever name called in respect of the residential accommodation occupied by him. In that case also, he cannot claim the HRA exemption. So there is a calculation for HRA exemption. It depends on the city where you are staying, HRA exemption. If one is staying in C is Chennai, D is for Delhi, K for Kolkata, and M for Mumbai, HRA exemption calculation is different. If you are staying in other than these cities, Chennai, Delhi, Kolkata, and Mumbai, calculation is different. If you are staying in any of these 4 cities, like these are all metro cities, there is a calculation. Employer is paying some 20,000 as HRA. Whether entire 20,000 you can claim as the exemption. It depends on least of these 3 amounts. Actual HRA received. Say example, 20,000. Rent paid in excess of 10% of salary or 50% of salary. So if one is made calculation as per these 3 elements, you will arrive one amount, whichever is the least. Example, you are earning per annum 50% salary, maybe per month maybe 50,000, and you are paying around rent of 30,000. So your salary is 1 lakh. 10% of salary is 10,000. So you are paying additional rent of 20,000. Then least of these 3 is 20,000. So 20,000 one can claim as a exemption, HRA exemption. So whatever is the salary, out of that HRA exemption will be deducted. If you are staying in other than these cities, first 2 conditions are same. Last 3rd condition only will be the change. This will become 40%. That's it. So for this also very important, you may get some practical problem also on this. So HRA exemption, how to calculate?
Can you explain one another time?
Okay. Maybe per month you are earning 1 lakh rupees as a salary. Able to see the Excel?
Not Excel, this Word document. Yeah.
Okay. I will change the. Okay. So monthly salary is 1 lakh. Out of that, maybe HRA employer is paying is 15,000. So the calculation is, example, you are staying in Chennai. So Chennai will come under CDK. Chennai, Delhi, Kolkata, Mumbai. And I am staying in Hyderabad. Okay. So first is the actual HRA received. So 15,000. 15,000. Second condition is rent paid in excess of 10% of salary. So here the 10% of salary is 10,000. Whereas we are paying 30,000 as a monthly rent. So what is the difference between these two? So 20,000. Third, because I am staying in Chennai, 50% of I'm staying in Hyderabad, I'll get only 40%. So out of these three elements, whichever is the least, 15,000 is the least amount. Here also 15,000. So from my salary of 1 lakh, this 15,000 is as a deduction for the purpose of income tax. We will get the income. So while submitting the income tax return, how much is my salary? On 85,000 only, I am liable to pay the tax because I am claiming HRA exemption.
Okay.
This is salary. So for this, when one need to submit rental receipt to the employer, so that the employee, while deducting the salary itself, he will give you the HRA exemption and he will not deduct the tax to that extent. So that's why out of these three, whatever is the least amount only, we are eligible to claim as the exemption, not entire amount. Okay, we'll move ahead, sir.
Yes, madam. This is very clear. Yes.
So this is HRA.
Okay. One more hour is there. Will you be able to complete? You can try.
Sir. Then by covering up to house property, almost 50% will be covered
Yeah, okay.
in the income tax.
Yeah, yeah.
Then next is the special allowances. Special allowance is given for meeting a special purpose. So certain special allowances, one is having the exemption. Like children education allowance. Per kid, one can claim exemption up to 2000 rupees. Certain allowances are not taxable also. Like some allowances, if you are going on tour, they will give you travel allowance. So that is not taxable because you are given that allowance for traveling purpose. And certain allowances are given to Supreme Court, High Court judges and all. So those allowances are not chargeable to tax. And some people they go and work in remote places where no one can reach also. Those places to make the employee happy or give him some financial assistance in the pay package they give. Like if one is going and working in some Kashmir or some mining area, some Naxals area, some kind of difficulty going to that area itself is a difficult. So those are all the special allowances. Certain allowances again, dearness allowance. If you see the government employee, they will get the dearness allowance. So that is also taxable. Then medical allowance, lunch allowances, overtime. If you are working overtime, you may be getting some overtime. So these are all allowances chargeable to tax. Only certain allowances we are having the exemptions, like children education allowance, hostel allowance, HRA. We can claim some exemptions. Otherwise, the rest are allowances are chargeable to tax. Next is the perquisites. Perquisites is already we just one hint I have given, like a police department or some doctors. Some people working in the government and all, or even private sector also, if some like accommodation is given by the company. So instead of paying it, if some 50,000 in that area, market rental is 50,000, but employer is charging only 20 or 25,000. So you are getting the benefit of 25,000 indirectly, right? That also concept is used in the income tax. So what happens? You are staying in that house and you are enjoying all the facilities. If the similar facilities, similar house, if you are taking outside in the same area, one is required to pay 50,000, but employer is deducting only 25,000. So you are availing a additional benefit of 25,000. Though you are not receiving it as a salary or in the cash form, you are enjoying that benefit. So that 25,000 is treated as the perquisite for the tax calculation purpose. So what they will do, employer, how many perquisites they are giving, they will monetize that, they will quantify the amount. On that, whatever is tax liable, they deduct that tax. Clear on this? Like some employers are they may give some interest free loan to the employees, or they may give some concessional, or in case of any support for the employee kids education and all, they may be giving some concessional rate. If you go outside, maybe you have to pay 12% per annum interest rate. Maybe employer is kind, he's giving only 6%. So if we are pocketing that 6% benefit, so that indirect benefit because of this employment, if your employer is giving, then that is treated as the perquisite, and perquisite is valued, and on that we are liable to pay the tax. So that is also treated as the perquisite, is also treated as the part of the salary. Sometimes if some IT companies employees are working, if they work for certain years, employer will give the shares of that company. So that is also an indirect benefit employee is getting. So that is also treated as a perquisite. Sometimes employer will give some lump sum amount as a token of we have given excellent service. So at the time of retirement they give. So these are all things are treated as the perquisites. So perquisite is also taxable. Then one more thing is, next is the profits in lieu of salary. If you go to page number 58, so perquisites are given in the page 57. And 58 is the profits in lieu of salary. Please remember these 5 points. Okay, in profits lieu of salary, first one is the terminal compensation. Like if you are at the time of retirement or resignation, employer will give a sum of amount. So that is treated as the terminal compensation. So that is also treated as the salary. Payment from an unrecognized provident fund or superannuation fund. So some employers, what they do, they don't contribute the PF to the EPFO, government fund and all. Some fund they only manage. If that fund is not recognized, even that whatever payment we get from that unrecognized provident fund is also salary. Payment and payment. Sorry.
Yeah, but sorry.
Next is the payment under key man insurance policy. You are in a key position in the business. So what employer will do, he will take an insurance on you. So because of that insurance policy, you may be getting some additional amount as at the time of maturity. So these are all profits in lieu of salary. So you indirectly you may be getting the money from the insurer, but because of the insurance taken by the employer, so you are earning that, you are getting that amount. So that is also treated as the salary. And even after resignation or at the time of joining also, if you are given some lump sum amount, so that is also treated as the salary. Or any amount, some name is not given, some amount you are getting from your employer, so it is also treated as the salary. Then come to the page 59. In page 59, for perquisites, there are 3 types of classifications. First classification is perquisites that are taxable in case of every employee. Perquisites taxable in case of specified employees. Specified employees like a person who is a very key position, like a director, or some employee, he may be working as the employee in the company, but he is having some 20 or 25% shares in that company. So those employees, if they are earning any specific benefit, that is also treated as the perquisite. And some perquisites are exempted for all employees. So these 3 categories, please remember. In case of every employee, what is the taxable? If it is rent-free accommodation is given, or accommodation is given, but only nominal amount employer is charging, or you have to pay some amount to some labor, like you may have taken some helper or some driver for your car, but your employer is paying that money. So that is also perquisite. And some insurance premium, like medical insurance premium and all, your employer is paying you. So that is also treated as the perquisite. So some interest-free loans are given. So that is also a perquisite. So all these perquisites are taxable to every employee. So perquisites which are taxable to only specified employee means directors and all. For them, additional facilities are given, like car is provided by the company and driver is also provided by the company. Some transportation facility, all these are monetized. How much is the impact? How much benefit he is getting? So this one, and which are tax free for all the employees. If any laptop is given, laptop is work related perquisite. Why he is giving you the laptop? To get the work. So you are not getting any benefit out of that laptop for your personal reason. He is giving for his own purpose. So if he is giving the laptops, computers and all, that is not treated as the perquisite. Then medical benefits, if anything is given, subject to some rules and regulations are there, that is also not treated as the benefit. And LTA, leave travel assistance. So every 2 years, if he is giving you that benefit, that is also not chargeable to tax. Then sometimes what happens, benefit is given for all the employees, not specifically like some gym is opened in your office for the benefit of employees, some recreation club. So these things are for the benefit of all the employees. It is not for a single employee specifically. So welfare measurement. So those are all perquisites are not chargeable as the tax. Hope it is clear.
Yes, madam. Yes, madam.
So this one is more important, what I'm highlighting now. So what is salary? In that salary, we are discussing each and every element by element. So far, we have discussed about allowances. We discussed about the perquisites. We discussed about the profits in lieu of salary. So in the perquisites, 3 different perquisites are there: taxable to all employees, only specified employees, exempted to all employees. Then in case of profits in lieu of salary, I told please remember those 5 points, like a key insurance policy and any sum of money you are paying at the time of retirement or resignation. Those things, please remember it. So this entire bold this thing is important. So again, come to the page 63. So already it is explained in the previous page, but one more time in the page 58 also they have given. Again in the page 63 also same thing is given. Page 64, if you see 1.1.2, this is also important thing. Maybe this is for your personal reason also, one can remember all these things. Like those who are in employment, they can very well correlate it. Like whether I am getting all these exemptions or not. If a gratuity, already I explained, once in a lifetime that gratuity we can claim as a exemption. Even commuted value of pension, one lump sum amount at the time of retirement as a pension we get, that also we can claim as the exemption. Then statutory provident fund, whatever we are receiving, and superannuation fund also. HRA exemption already we have discussed. So these are all one can claim as the exemptions from the salary. Then page 67, perquisites are not taxable. Already all these things are covered in the previous topics, and some points already I have discussed. Like if employee is going on transfer to new place, so initial 15 days they may give stay in a hotel and all. So that charges are paid by the employer. But that is a for the because of transfer they are giving that benefit. So that is not chargeable to tax. Like rent-free accommodation given to judges of High Court, Supreme Court, members of Parliament, and some accommodation even for normal employees also. If they are working in mining area, sensitive areas and all, employer only maybe getting the house outside may be not safe and not possible also. In those cases, employer only will provide the house. So those cases also in the remote areas, that perquisite is not taxable. Then perquisites are valued. How it is charged to tax? Because how much money it is to be recovered. If you are taking house, if those who are relevant in Chennai, they can make out. Maybe some person is staying near airport. A rental in that area may be different. And if employer is paying the accommodation in that area, then that valuation will differ. One is staying in maybe Mylapore, Gopalapuram, or this T Nagar area. Maybe valuation of that house is different. So it depends on the rules and regulation. If it is state and central government employees, already government will notify. In that way, they calculate the how much amount is treated as the perquisite. In case of other employees, usually they go by the market value, or if accommodation is owned by the employer, then what is the market value? If an employer is taking on lease, already he is paying the rent to outsider, so that itself will become the value of that accommodation. So with this, we can conclude the salary income under the head salaries. If you see the page number 70, last conclusion, what is salary? CCA. CCA means city compensatory allowance. Because of staying in city, we incur more expenditure. So one allowance is given by the employer as CCA. Then dearness allowance, HRA. So everything is chargeable to tax. So any doubts on this?
No, madam, not in salaries and direct income.
Okay. Just a minute, sir. So out of 5 heads, we have covered salary head. Next is somebody told income from the rent. So it is called as income from house property. So here properties, it may be residential or commercial.
Okay. You are sharing something, madam?
Yes, yes.
Okay.
So here it is residential or commercial property. So it may be a building or land attached to that building. So buildings are lands appertaining to they. If you go to the page number 71, and assessee is the assessee must be the owner of that property. Owner or deemed owner. Not used for business or profession. Like you may be having a property, but you are using it for your office purpose. Then that property is not considered for the house property purpose. So these 5 conditions must be satisfied. So there must be a building or land attached to that building, and that must be maybe a residential or commercial property, and assessee must be the owner or deemed owner of that property, and that property is not used for the business or profession. In that case, if that is satisfied, whatever is the income we are getting, whatever is the value of that property, it is charged to tax under the income from house property. Like salary, when it is charged under the salary, when you are getting an income from an employer and there is a employer-employee relationship. That condition must be satisfied to charge under the head income from salaries. Same way, to get charged under the income from house property, these conditions must be satisfied. Then only it will go into the income from house property. Because you may be having a vacant plot and you are giving as a lease for a nursery, and per month you may be getting some rental income. So because it is a vacant land, you cannot claim it as a income from house property. So that's why all these 4 conditions are important. Then what is chargeable here? Value of properties. It is not your rent. Value of property is chargeable to tax. Otherwise, what will happen? One may be having a good commercial property in the T Nagar, and simply for the purpose of income tax, they may tell I am getting only 5,000 as rent per month. So it is not the whatever rent you are getting, it is the value of the property. Annual value of that property is charged to income from house property.
But how come the value of property?
Value of property means it is not the sale value of the property. It is how much of that property is able to yield. Like rental, you may be having a house in T Nagar. Simply you cannot tell that I am earning only 5,000 rental income per month. Okay. That area, what is the notified rental income? Maybe 20,000. So you are liable to pay the value of the property, means how much is the income one can earn from that property.
But for charity purpose or known relative, if I am letting it for very less rent also.
Then also because you are voluntarily you are foregoing your income.
Okay.
Then here we have termed one this thing, owner or deemed owner. So if you are having objection to ownership, there is no issue, you are the owner. Then when it will become a deemed ownership, to avoid the tax, some people what they do, they transfer the property in the name of their kids, their spouse, thinking that I am not the owner of the property. So in that case, effectively, who is controlling that? He is only. Just to avoid the tax, if any transfer of assets takes place within the family members, then he or she is considered as a deemed owner. So even in case of deemed ownership also, one is liable to pay the tax on whatever the rental value he is getting. Sometimes what happens, you may not be the owner of the property. Maybe documents are not there. But still you are you are enjoying the possession of that building. Maybe a combined property where a big bungalow is there. Everyone is having a share. Maybe that property is it is a joint property. So even though it is not effectively on your name, you are enjoying that property. Because you cannot divide, you cannot show this portion of flat is only mine. but you are getting some income out of entire building. So in that case also you are assumed as a deemed owner. Next is the page number 79. So the chargeability we understood. Now how to derive the income from house property? Like salary we have arrived, basic salary, some allowances, all these forms part of the salary. Then only it is liable for the income tax. Same way, one has to arrive the value. Tax is charged on the income, right? So you have to arrive that income number. So for that only all rules and all sections will give you the determination rules, how one can determine the value. Here the property is, say for example, it is a residential property. There are two types of residential properties. One is you are staying on your own. You bought a flat or you bought an independent house and you are staying in your own house. Then in that case, how to calculate the income from house property? Or you are owning the house, but you are giving in on the rent. If that is the case, that is the second situation. How to calculate the rent? Then third, all of us must have taken the housing loan, thinking that we will get some income tax benefit. So how to treat that loan amount in case of income calculation? Then different scenarios. Maybe suddenly house has become vacant, 3 months no one has come. In that case, how to calculate the income? So these are all explained in the 79 page onwards. If it is self-occupied property, first is I will start writing the notes. So please remember, self-occupied property value is nil. If it is let out property, but here there are a lot of conditions. If you go to the page number 80, if you are staying in your own house, then I think last 2 years back, one more provision has come into this. Like because of children education and all, more than one house property you may be need. Like if your kids are studying in some other city, because of your employment, you are staying in one house, and your kids, because of their education, you have taken some other house in some other city. Maybe kids are studying some city like Madurai and you are staying in Chennai. There also you bought a house for their, and there also they are using for your own residential purpose. In that case also, that second house is also treated as a nil. Usually earlier only one house property used to be given as the own use. So if you are using the two houses or three houses also, only one you can claim as the self-occupied property, and rest two properties they will treat it as income tax, will treat it as the let out property, and you are liable to pay the tax. Because of the latest scenarios and all, and now they have considered one more house property in some other city, not in the same city. If it is in some other city, you are using it here for self-occupied, even that property also one can claim as a self-occupied property. Why? Because why it is important self-occupied property is your income is nil. If your income is nil, you need not pay any income tax on that, right? If it is treated as a let out property, you are liable to pay the income tax. That's why self-occupied property is, earlier it used to be one, now even second property also one can claim as a self-occupied property. So here there are different conditions are there even for using the self-occupied property. Go to page number 80. Assessee must be owner of only one house property, unable to occupy because of his employment business. The property should not have been actually let out. reside at the place of employment without ownership, not derive any benefit from property not occupied. In those cases also, it is treated as the self-occupied property and nil income will come. Then if next is the let out property. So for let out property, how to derive the annual value? In the point 5, we have seen value of property is charged as the income from house property. Then what is that value? That value is annual value. So annual value conditions is property is let out during the year or whole year or during the let out for the whole year or so there is a rental control legislation is there. So the example, just a few minutes back only we discussed. Like one is having a house in T Nagar and he is telling 5,000 only I have earned from that per month. I have given only rental for 5,000. So my property, my rental income is 60,000 per annum. So in those cases, department will question. So whatever is the rental fair value of rent in those areas, that market value of the rent, that is taken as the rental value. Otherwise, usually if you are giving the at par with those market rates, there is no issue. Whatever is the let out value, whatever is the rental we have given, that itself can be treated as the annual value. But your annual value is much lesser than the fair market value. Then in that case, fair market value is only to be adapted as the annual value of the house property. In case of let out property, if a property is vacant for certain amount, certain period, so only when it is occupied, during that period, whatever rent is earned, only that period rent is to be taken, realized rent as the gross annual. And sometimes what happens? Tenant will not pay the rent, though you have given for the full year. Unrealized some rental value is there. Tenant default. In that case also, you can exclude the unrealized rent. And also, here you have to prove that simply my tenant has not paid. You have taken the legal action and all those things. You must be having the sufficient proof to prove that my tenant has defaulted me and he is not occupied any other property of yours, and you have taken this legal action and you have taken the sufficient measures to recover the rent. Despite of all these things, if he is not paying your rent, then you can exclude the unrealized rent. So one is vacant. In case of vacancy, then that period rent you cannot show it as a rental value. Then if a tenant default is there also, then you can exclude that unrealized rent. But if you are receiving any arrears of rent, then that is to be added, because here you are showing tenant defaulted. After 1 year he came back and sorry, because now I'm earning, I have sufficient money, take your rent. So you are getting your arrears of rent. No? So in that case again, show it as the rent. Then next is the Interest on borrowed capital. Why you are borrowing a capital? This is only for borrowing the house property, not for any other purpose. If you are taking a personal loan and you cannot claim it as a borrowed, I have borrowed the capital for this house. You must exclusively for borrowing that property only. Then you can claim as the borrowed capital. Then how much you can take? At max rupees 2 lakhs per annum. What is that? Interest.
This interest is not taxable.
Interest is not taxable. Not taxable. Like how we have calculated the salary. First we have arrived the gross salary. From that HRA we have deducted, right? Same way here we first figure is gross annual value we will get. From that whatever is the interest we paid on borrowed capital we will deduct it. But there is a ceiling for that. So 2 lakhs per annum only you can claim as a interest on borrowed capital. And from a recognized financial institution only you have to take that loan. Simply we cannot for the sake of this benefit I have taken loan from my wife, I have taken loan from my father. So all these things you cannot claim the interest on borrowed capital. You must be taking from financial institution. Here if you go to the page number 82. Page number 82.1.16.9 computation of interest on borrowed capital. Here 1,50,000 is given. I have a doubt. I think it is 2 lakhs. So just let us cross check this point.
Yeah, it is 2 lakhs only, madam. 2 lakhs.
So your book is okay. Then they have given the condition. Capital is borrowed on or after April 1st, 99. And this is acquisition or construction is completed within 3 years. Person extending the loan certifies that such interest is payable in respect of the amount advanced for acquisition or construction of house. Like if you are taking from financial institution, they give a interest certificate also. Then only you can take exemption for that. One more point is there, 1.16.10. See, this provision is talking about only interest on borrowed capital in the house property. But section 80C talks about so many deductions. See, one is earning income from 5 different sources, right? Salary, house property by selling the properties, from business or profession or other sources. From all these things, certain exemptions are allowed to all the persons, irrespective of income source. So those exemptions are covered in section 80C. And contribution to NPS and certain like disabilities and all are there. Those kind of people, certain exemptions are there. So in case of section 80C, even if you are paying principal, say example, you have taken loan of 50 lakhs from the bank for purchase of this house property. So per annum you are paying some 5 lakhs as a interest on that capital. So that 5 lakhs, out of 5 lakhs, 2 lakhs you can claim in the house property, and the remaining 3 lakhs you cannot do anything. You have to bear that. And a certain amount you are repaying to the banker as the principal. So that principal will be covered under section 80C. So in 80C, up to 1,50,000, you can claim as the principal repayment towards this house property also you can claim. But 80C is a very vast section. Like 1,50,000 can be anything, like admission fee to your children, school admission fee, school tuition fee, and your LIC premiums, and your PF, your PPF, then principal payment towards housing loan. It's a very vast. All put together, you cannot claim more than 1,50,000. I got it.
Yes, madam, it is clear. It is clear. Yes.
So section 80C is only for the principal amount and housing loan. Just I'm writing, don't get confused here, because in this book it is given, I'm explaining you.
Yeah, it is considered only principal, right? 80C, but where it is, but where this interest property comes in which section, madam?
Interest, I think section 24 it comes. Here he is not given,
Okay.
but it is section 24.
24. Okay. Yeah.
Then one more thing. What are all the exemptions? What are all the deductions you can make from your gross annual value? One is interest on borrowed capital. Next is municipal taxes, whatever actually paid. Because these are all expenditure we are incurring for that property, right? So whatever municipal taxes paid, then 30% of the gross annual value as deduction. Like one is having house means we incur some expenditure for maintenance, right?
Yeah.
Maybe every year you need to make some painting or some small repairs. All these things is to be carried out. So Income Tax Act is giving 30% as a gross annual value as deduction. So if you are earning some every month 30,000, maybe your rental income. So 3.6 lakhs. Out of 3.6 lakhs, maybe you are paying 10,000 for municipal taxes. That is also deduction. And 30% of your 3,60,000. So maybe up to 1 lakh come out as a standard deduction. Then minus you are having additional 2 lakhs as the interest. So your net will be the amount chargeable under the head income from house property.
Okay.
So this one is deduction. Point B is deduction. Even point D is also deduction. And there are a lot of provisions. I don't know. I didn't see the questions and answers to what extent they have asked. But if you go to page 84, 1.16.13 deductions under section 24. There are 3 types of deductions are allowed. Standard deduction already we have discussed, 30% of net annual value. Interest and borrowed capital already we have covered. Interest prior to the construction of a house, this we have not covered. Example, 2020 you booked a flat and 2023 only we got the possession. So since when we are enjoying that house, whether self-occupied or let out, since from 2023. But since when we have taken the loan, 2020 onwards we started taking the loan and we are paying the interest to the banker. So 2020 to 21, 21 to 22, 22 to 23. 3 financial years we have paid the banker interest. What about that interest? That interest is also eligible for deduction from the house property because your house is getting ready. So whatever is incurred, that next 5 years you can claim as a exemption. Like how we have claimed interest on borrowed capital, next 5 years prior period. construction, period, borrowing, cost. So same all these provisions only. If you go to page 88 also, everything again they have explained very detailedly. One more thing is I have not explained. Property income exempted from tax. If you go to page 89, the same thing. If you see 1.17.3 in page 89, already it is explained in the previous chapter itself. Even 1.17.4, deduction under section 80C. So that was also already discussed. The only thing is you go through in detail. Then property income exempted from tax, like farmhouse, annual value of one place in occupation of an ex-ruler, like for ex-rulers and all, one property they select. So whatever income they are getting from that one property is exempted from house property. And property income of a local authority, scientific research institution, then hospital, educational institutions, trade unions, and if it is used for charitable purposes and political party. And last condition, if you see next page, go to page 90, I and J. If you see income from property used for own business or profession. If you go to the here, fourth point already we have covered, not used for business or profession. If you are using for business or profession, it will be treated under the business and income from business or profession head, income under that head. So it will not come under the house property. And annual value of one self-occupied property is also exempted, like value will be nil. So if you see page 90, 1.17.6. So GAV minus rent which could not be realized minus taxes paid. If you take out all these things, you will get the net annual value. From that, again, two more deductions are there. Statutory standard deduction, that is 30% of net annual value. Then interest on borrowed capital. So this way, one can calculate the income from house property. That is why this one is very simple. So with this, we have covered two heads of property. Two more heads are important, profits and gains of business or profession and capital gains. Then fifth one is income from other sources is very small. Maybe if you take another 2 hours, I think we can complete remaining 3 heads also.
Madam, what I am seeing is that income from house, till income from house property, they have asked in the 5-year question paper. Okay.
Okay.
And then let me share my screen.
Okay.
I will tell what we can do in this. Yeah. So this one, marked as, dots and dot circle. Okay, dot circle is actually 8 marks and this is 3 marks. So this particular thing, they have not asked anything in the exam. So what we can do is income from house property, we can stop here. Okay. For today. In next class, we can cover this law and procedure for assessment. Okay, and then remedies and penalties and prosecution.
Okay, this is more important.
Yeah. Okay, then we can complete this. See, this wealth tax is asked for, like in every question paper it is there. So wealth tax and this CST, VAT and this GST. Maybe
I don't have much idea on VAT and APGST.
That is okay. So that's okay. So we can have something on CST and GST and goods and service tax. That should be fine.
Okay.
Will that be fine for you?
Okay. If that is the case, okay. I will let you know the timing, sir.
Yes, yeah, sure, madam. Anytime suitable for you.
Okay. Because I will go through this and how much it is, how much time it will take, and I
Yeah.
will let you know. So instead
Yes.
of going for the next remaining three heads, I think this will be more value addition to you.
Yes, correct. Because
Scoring.
actually they have not asked anything, any actually not even in last
Oh,
5 question paper.
okay.
Because the
Okay,
division
maybe
of
for
most
your
property is
personal
very
also up
important.
to this you can understand.
Okay,
Idea
okay.
about this.
Yeah,
Okay.
sure. So probably we can, if you have time, we can touch this later. So this,
Okay.
we will go to this law procedure for assessment remedies, and then we will come here, madam.
Okay. Okay, law and procedure, remedies, appeals, penalties, and all.
Penalties prosecution,
Wealth tax.
and then wealth tax. See, in this actually,
Yes.
whichever you are not comfortable, you let me know. I will pitch in, and I can also take that one.
Okay, sir. Let me go through it. It may not take. It may not be much difficult.
Okay, sure.
Only thing is timing. Meanwhile, you finish other subjects. I will
Hmm.
see my availability and this thing. Maybe I think 2 more sessions are needed for all these things.
Yeah, okay, ma'am. Sure, we will do it.
Okay, sir. Huh?
Yeah. Any other questions for the people?
Maybe if any, sir, you go through the questions whatever we have covered so far.
Hmm. Okay, sure. You
So
can
if
also send
anything is
that.
there, we can discuss in the next
Yeah,
class.
you can also send the document in WhatsApp.
Okay, sir.
Okay, that will actually help.
Okay.
Yeah. Okay. Okay, then.
Okay, thank you,
Thank
sir.
you, madam.
Have a good day.
Thank you all. Thank you then.
Thank
Yeah.
you, sir.
So how income tax is calculated for every assessment year? Even wealth tax is also calculated, charged for every assessment year on any individual, HUF or company at the rate of 1% on the net wealth on a valuation date. Usually valuation date is 31st March of every year. So it is 1% on the net wealth of an individual or HUF or a company. So here what are the important points to remember is net wealth. So how a net wealth is calculated for a person? It is the value of assets belonging to SSC as on 31st March. On that, some deemed assets are there. Like last time also we have discussed about the deemed assets. Like somebody wants to evade the tax, what they do, they transfer some assets to spouse or minor child or some other family member. So similar way here also. And some assets are exempt from calculation of the wealth tax. So if we deduct all those assets and a person like how his wealth is charged to wealth tax, his debts also is to be deducted. So netting of all these things, it will give the net wealth. On net wealth, the 1% is the wealth tax. For income tax, we understood that residential status of an individual is very important. Similar way, it is there in the page number 153. This topic starts from 153 page. So wealth tax is charged on the basis of the residential status of a person. So residential status, when broadly we discussed, a person can be a resident or non-resident. Within the resident also we understood that resident and ordinarily resident. Resident but not ordinarily resident. Then non-resident. So here the citizenship also plays an important role. So if a person is a citizen of India And even if he is a non-resident also, if he is having assets in India and if his net wealth is more than 30 lakhs, he is liable to pay to tax, wealth tax. And similarly, if a person is a citizen of India and he is a resident and ordinary resident, in that case, even his wealth in abroad, other countries is also chargeable to tax. So if a non-citizen is having assets in India, then also only for Indian assets, he is also liable to pay the wealth tax at the rate of 1% on net wealth. So here the citizenship is having residential status and nationality as a person. Key criteria. Then valuation of assets dated up to 31st March. When we see the calculation of the net wealth, the value of the then the key component here, key definition, what is an asset? So here assets are priority the building or land, then commercial buildings, residential buildings, farmhouse situated within 25 kilometers of a municipality limits. So broad, first is the building. There are some exceptions. Which building can be considered, which building cannot be considered as the asset. So what cannot be considered as the building? Residential purpose, if one is holding the building. Also, if assessee is in the business of real estate, so till the time he sells, that will be his assets. That will be his stock in trade. So that stock in trade cannot be considered as a asset. So that is an exemption. Then if any residential property is given for rent in a previous financial year for more than 300 days, and if the property is in the nature of commercial establishment, in that case, that building is not considered for the calculation of the wealth. Then second is the motor cars. Then even in motor cars also, if the assessee is in the business of playing the vehicles, giving rent vehicles on rent, he may be having very expensive cars and all. But if he is in the business of giving it on rentals, then that motor cars are not covered. Then third is jewelry, bullion, furniture, and expensive like silver utensils, articles, partly gold, platinum, precious metals. So all this such type of jewels also part of the wealth. Then boats, aircrafts, yachts, these things also part of the wealth. Then any urban land. Urban land means situated within the local municipal authority. Then cash in hand in excess of 50,000. So these are all considered as assets in the definition of the assets. Then one more thing we saw, what is the deemed assets? As explained previously, if to evade the tax, if one transfer the assets to spouse, then son's wife, and for the benefit of son's wife, then if he is holding the interest in any firm and firm assets also, these are all treated as the deemed assets. Though assessee is not having directly assets on his name, because these are all related to him. To evade the tax, he must have transferred to some other persons. So these assets also will be considered in the wealth. Then some assets are exempted. Like if any property held under trust, then if in case assessee is a member in an HUF, so there is an undivided property. So that is also an exempted one. Then farmer rulers. So when India got the freedom, each ruler, if you see like palaces in Rajasthan and all, so each ruler, the government has given one palace. So that may be very value wise, it may be in hundreds of crores, but that one property is as an exempted property. And also for rulers, that time even jewelry also government has exempted. So if such kind of jewelry anything is held by the farmer rulers, then that is also an exempted asset. So if any assets bought by person of Indian origin, like maybe second generation, maybe parents would have gone to some foreign country and settled there. So their kids and all, if they bring some money or properties, some assets to India, so that is also an exempted assets. Then valuation of assets. So then how the value of an asset is determined. So this is determined by the some rules and regulations are given valuation of property. As per that, it is so in depth it is not required. So this much is enough as per your book. So just simply remember that table. What is the net wealth? So in that net wealth, what is the asset, deemed asset, exempted assets. So if any debts are incurred in acquiring these assets, that can be deducted in the net wealth. So this is the income tax related, wealth tax related. Then overall the people liable for assets liable for wealth taxes, company, HUF, individual, association of persons, non-cooperative taxpayers whose accounts is to be audited. Like if somebody is not filing his return, but he's having assets and all, they are also like. So broadly, it is depending on the citizenship status. Then even in non-citizens also, resident and if they are holding any assets in India, they are also liable for the wealth tax. So not much very detailed thing about the wealth tax. So just these definitions, please remember. Those what are all the assets, exempted assets. Within the assets also, some buildings and all are not part of the wealth tax. So jewelry, all these things. So these are all very general these things only one can easily remember. So this is total wealth tax. Is it clear? Any doubts, or shall we proceed further?
No, madam, it's very clear.
Okay, fine. Then next topic is page number 163. Indirect taxes. Merits and demerits of indirect taxes. See, it is very simple. One can easily assess what are all the merits. Usually, income tax is a direct taxes. So when we pay the income tax, we feel the pinch of it. Array, government is taking this much money from me, but what benefits I am getting? My neighbor is earning so much in the business, but he is not paying any tax. So we feel that pinch on the income tax. This is, as the name suggests, it's an indirect tax. So it is always hidden. So if you buy any item, you may be knowing some tax is liable on that, and you are paying some tax. But generally, we don't pay much concentration like how much we are paying. So it's a hidden tax. And chances of tax evasion is very minimal. It is almost not possible also. So anyone even buying a small item also, they may be paying 5% GST on that. Even if we are eating somewhere outside some normal eatery also, the moment he gives the bill, chart kind of thing. If you go and have some coffee in a normal coffee shop, like Madras coffee, all these things, everywhere, wherever they give bill, if you see 5% GST. So evasion is very minimal in this. And it propels the economy, like seeing the tax, indirect tax benefits, lot of economic activities will take up. Okay. So like a lot of industries, lot of investments people will keep. But what are all the demerits is on some items, these taxes are very huge. So it will discourage people to consume the goods like expensive watches, all those things. Sometimes it will attract 28% of GST. So because of huge taxation percentage, maybe we get discouraged to consume all those things. So this topic is very simple one. We are done with this topic. Next, we can go with the Central Sales Tax Act 1956, page number 166. Shall we proceed? Okay. This act used to be having very significant prior to GST, because prior to GST, every state used to have their own either state the goods GST Act of their own, like goods and now it is GST, general sales tax, like that they used to have, or value added tax, VAT Act, like that. So that time CST used to be having very significant role, because all those acts govern the sales taken place within that state. Then which law will govern the taxes when the goods sales takes place between two states? So this is the answer for that, Central Sales Tax Act 1956. But now post GST, only 5 items are exempted from GST, like crude oil, natural gas. These are all petroleum products only. Petrol and diesel, aviation turbine fuel. If you take these 4 only, these 5 are there related to petroleum industry, and 5th one is alcohol for human consumptions. So now only these 6 are exempted from GST. So any activity takes place between the states, between two sales taken place between 2 states will govern by the Central Sales Tax Act. So if you take any union territories like Pondicherry and all, they don't have any petroleum supply companies. If you take any company, they may not be having the setups there, because volumes are very less, and moving the product from some other state and establishing their supply locations and all is very difficult. What they do, they may be supplying from Pondicherry, is very close to Chennai, or Karaikal and all is very close to Trichy. What they do, they supply from the either Trichy or Chennai to Pondicherry districts. So in that case, the movement between these 2 states is governed by the Central Sales Tax Act. So GST is not applicable. If GST is applicable, CST will not come into the picture. So you are like once when you are buying any item from the Amazon, please notice sometimes we get the items from the Delhi, some other states, not from the within the same state. So in that case, if you see, it is IGST is applicable. So only for these 5-6 products where GST is not applicable, still CST is applicable. So this is the background of the CST. So if the sales takes place between 2 states, Central Sales Tax is applicable. Page number 166 onwards, this topic starts. So some important definitions are there. Very frequently these definitions are asked. What is a business? And these definitions are very much useful in even next like AP GST Act, those cases also. So please remember, any business means trade, commerce, manufacturing. These are all common definitions. Once you remember for CST Act, it is applicable for every act. Then who is the dealer? Like a person dealing in buying, selling, supplying, distribution of goods. He is called a dealer. He may be an individual, or he may be a company, HUF, association of persons. Then he may be a commission agent, or he may be a broker. So who carries on behalf of principal is also a dealer. It is there in the page 168. So in the page 168, please remember the definition business, because these are all very common definitions in any act. Maybe minor variations will be there. Then dealer also, this is also a common definition. Then next important thing is declared goods. So this definition also please remember. So declared goods are goods of special importance in interstate trade or commerce. If you notice, exporting rice from Tamil Nadu to other states is banned, because that is a goods of special importance, like pulses, all those things, because they wanted to ensure the food security in their own state. So the state government may impose some restrictions on selling those items. So these are all the declared goods, like cereals, coal, cotton, crude oil, oil seeds, pulses, sugar, etc. So please remember this definition also, very important one. Then next is goods. Goods are like materials, articles, commodities, mobile, but it does not include the newspaper, actionable claims, stocks, shares, and securities. Please remember these definitions, because this is very simple topic, CST easily you all can score good marks in this. Then one more important definition is sale. What is the sale? Sale means transfer of any property or goods from one person to other person for some consideration. That consideration may be in the form of cash or some other deferred payment or any other valuable consideration. Like even it may be a barter exchange also. Sometimes you are giving some X article to some other business and in turn he is giving some Y article, some Y goods. So that way also it is a sale. Then what is the sale price? In exchange of these goods or property, what we are paying to the dealer consideration. So that is the sale price. It may so from sale price, if any cash discounts are there, you need to reduce. And then what is the turnover? Is the aggregate sale price received by the dealer for doing business during the financial year. Then what is interstate sale? Actually, the CST sale is applicable only for interstate sale. So this definition is a very important definition. So interstate sale takes place in a form, 2 points you need to remember. So it always interstate sale means there must be a movement of goods from one state to another state. And sometimes even sale may be effected by transfer of documents. When it will happen by transfer of documents? Company A is having a godown in maybe Karnataka, and they are having godown in Tamil Nadu also. They are manufacturing goods in Karnataka, and they wanted to transfer it to as a stock transfer to their depot in Tamil Nadu. So they will transfer it. So it is a stock transfer only. So there is no sale involving interstate movement. So the CST will not come. But during the course of this transfer, what happens? Maybe some deal happens. Somebody wants to buy those goods. So before reaching the depot itself, they are transferring the goods by transfer of title documents. So in that case, this is considered as an interstate sale also. Originally, it is a stock transfer, but later, because of transfer of documents, sale is happening. So point A and point B in page 169. Definition 4.1.2.9. Please remember this decision. So maybe goods are in the moment of sale. So later that sale happens because of some contract and that. So in that case also it is an interstate sale. Then one more important definition is export or import sale. Export or import sale, always what happens, person or company needs a export license or import license. This is not very easy for any small business. Like lot of toys made in some parts of like wooden toys, some goods of special importance, maybe they sell it in abroad. But that artisan may be a small person. He cannot directly export to foreign country. So actually one person who can collect all those things and he will sell as an exporter. But for this artisan, whether it will become an export to say? Because in case of export, this CST is not applicable. So even if he is not directly exporting, but the purpose of this sale is to effect the export. So in that case, the CST Act is not applicable. So that's why penultimate sale. This is called penultimate sale. Ultimate sale is export, but previous to export, the transaction is intention of the transaction is to effect the export. So that is what if you see 4.1.5, that is called pre-export sale or penultimate sale or sale for export. So everyone cannot take the export license or import license. So ultimately, the previous transaction is also treated as export and CST is not applicable. What is export? Very simple definition. Movement of goods from place from India to some other outside India. Same way, bringing the goods from outside India to India is the import. Then next is page 171. Liability to tax on interstate sales. Sorry for the interruption. Next, liability to tax and interstate sale. Usually, dealer is liable to pay the interstate sale is there, means dealer is liable to pay the CST. But sometimes what happens, some goods there may be an exemption within the state if the sale takes place within the state. But if it is an interstate sale, then again it is liable to nothing to do with the local sales tax. So interstate sale means whatever is the taxes they prescribe in their own state, that is applicable. So to claim that exemption, again, what can be done is there are three conditions. Sale must be from one registered dealer to another registered dealer, and the movement of goods is taking place, and transfer of document is also taking place. Usually, always the CST rate is equivalent to local sales tax. If you take petroleum products like petrol or diesel, whatever is the chargeable tax rate in that state, same will be the CST rate, even if transferred to some other state. So to claim the exemption, what happens? Because if the ultimate purpose of that movement is retail selling and all, so what they will do, government will issue a concessional C form. So if the sale takes place between one registered seller to another registered dealer, then they go to the department and they declare this much quantity of goods we are buying from state X to state Y. Please give us exemption. If they give the exemption, it may be an exemption or it may be some concessional rate of tax instead of some 15% or 20% of the tax. There may be exemption. So that's why these three conditions are stated in page 171. To claim that exemption, sale must be taken place from one registered dealer to another registered dealer in another state, and movement of goods and transfer of documents takes place. Then consignment tax. Sometimes what happens, simply it is a branch transfer from one location to other locations, like previous example. Godown may be there in state X and state Y. So in that case, it is not an interstate sale, so no tax is applicable. But there must be a proof, and that proof dealer must be in a position to support that movement. It is not the sale, it is only a branch transfer or consignment transfer. If that burden is on the dealer, if the dealer is able to prove that, then it is exempted from the CST. The next is the registration of dealers. This is compulsory. Whoever is liable to transfer to goods between one state to another. It's a voluntary registration, and benefits of registration. These things you can go through. Then appeals and all, if any issue between the tax authorities and the dealer within 30 days of issue of that order, one can appeal. Then cancellation of registration when it can takes place means if dealer is coming out of the business or he wanted to for CST also one has to furnish a security bond with the department. Because he has to goods are going to some other state, so they don't have any authority to confiscate the goods if the dealer fails to discharge his tax liability. So always he will give the surety bond. So if a dealer fails to give that surety bond also, registration will be cancelled. And then liability, page number 173, liability in special cases. Who is the appropriate authority? Usually company or private company, all those things. And the duties and liabilities of liquidator. Liquidator means one must be knowing if one goes into out of business because of huge debts and they're not able to operate the business. So court will appoint a liquidator. So similar way, even if tax is due to the government, what that liquidator will do? He will liquidate the assets, and whatever proceeds they get, they will discharge the CST liability. So that is what they told in this. So the procedure is given, like within 30 days of his appointment as liquidator, he has to communicate it to appropriate authority. Then even after liquidation process also, liquidator he has to pay the whatever is the tax. Then if any dispute, then you can one can go to appeal. Then within that appeal, like how to dispose of that appeals and all is given. Just please see whether any questions are asked on this, because it is similar to income tax. Maybe in income tax we'll cover it fully, that appeals and all. Any doubts and any further repetition is required in CST, because we have come to an end in the CST.
Oh, it's fine only. You can go ahead.
Okay, next is the VAT. It is a simple, very simple topic. Like no longer VAT. VAT is applicable only for the products which are not covered in GST. So not very much important, but still you can see see the previous question papers. If still they are asking, you can just go through the points to remember or something. You can write it as value added taxes. Like earlier, it used to be sales tax. So simply what it used to happen, if you buy any item, whatever is the applicable sales tax that you pay in the price of that item. What happens? Example, you take the manufacturer of a car. Car manufacturer, what work he does? He will manufacture only the maybe engine, rest all, like tires, every element, every item used in the car, he will buy from his suppliers. For each and every item, there will be a supplier. So when he is buying from that supplier, what happens? For each and every article, whatever is the applicable sales tax, it is loaded in that price. So what this car manufacturer fellow will do, he will take this 400 or 500 items to design a car. So he will fit everything and he will assemble everything, and he will finally make the prices some 10 lakhs. So in the 10 lakhs, whatever is the applicable sales tax, again he will do. So what happens in this process, whatever raw material or whatever items he purchased, already sales tax is involved in that. So again, what we are doing, whatever is the item cost plus sales tax on that, whatever is the value addition is doing on that, we are paying the tax. So it is what it is happening. It is the double tax. Like he is buying maybe tires for some 2 lakhs rupees. In that 2 lakhs rupees, maybe 20,000 is already involved as the sales tax. So when the final car price is 10 lakhs, in that 10 lakhs, again, what happens? Maybe 20% means 2 lakhs will be the sales tax. So if you take this 20,000 also, on this 20,000, whatever is sales tax involved and the tire cost, again we are incurring another 20% of the sales tax. So double taxation, tax and tax we are paying. So to avoid that, all the states introduced value added tax. So tax is collected in each and every stage of the value addition in case of sale of goods. But what he will do, this car manufacturer, car price may be 10 lakhs. In that 20%, 2 lakhs is involved as the sales tax. But already out of 2 lakhs, when procuring all these parts, accessories, he might have already paid some 50,000 sales tax. So what he will do? 2 lakhs minus 50,000 he will do. So that way what happens, only on the value addition part, whatever it is done, only tax is applicable. So what will happen? Our net tax is only, it will become, tax liability will become only 1,50,000. So this is the purpose of VAT. So like more transparency will come, but now VAT is only for limited goods. Just see any questions are asked in the previous last 2-3 exams. So accordingly, but whatever is given in like your textbook, this book, and whatever questions are asked, there is no relevance at all. Next is the AP GST Act 1957. AP GST Act, earlier I told, after introduction of GST Act, in 2017. This is applicable only for now remaining 6 goods like crude, natural gas, petroleum products, then liquor for human consumption. So this act is also now applicable only for this. When state bifurcation has taken place in 2014, then APGST Act is taken place, like they have adopted APGST Act. So here if you see the definitions, what is business? Business includes in the page number 183. So it is similar to CST Act. Then who is the dealer? This is also similar to only sections, and section may be changed, but like it is a duplication. Once you remember definition in one of these things, you can write in remaining acts also. Even page 185 turnover also. Total turnover is aggregate turnover, all the goods the dealer has undertaken last previous year. That is his turnover. For registration of a dealer under APGST Act, one must be having turnover not less than 50,000. He may be carrying out business in any of the commodities, and even works contractors. Works contractor means those who are in the civil works also. They have to go for this one. And CST Act also, if one dealer is covered under CST Act, he need to get registered under APGST Act. Then every miller, every commission agent. So all these things, please remember, it is very simple definitions only. Procedure for registration. Procedure for registration is like submitting the declarations, registration ID, registration forms, all these things. So this is also very simple act. Most of the definitions are common. Either you take CST or APGST Act. Then we are coming to GST Act. Goods and Service Tax Act 2017. So just let us have a brief about the history of GST. Prior to GST, what happens? Each and every state is having their own sales tax act or VAT act. So what happened? They wanted to bring entire country, one nation, like one tax kind of thing. So then they have introduced the GST. But journey of GST, like now, though introduction is happened in 2017, like a lot of work has taken place prior to more than 10 years back. Like in 2006, when Atal Bihari Vajpayee itself, they wanted to introduce the GST Act. After that, again, 2011 also, the time UPA, when UPA government was there, they also tried to take the GST Act into implementation, but it has not taken place. Then again in the 2014, when India government came into power, they introduced the bill in Lok Sabha. So once Lok Sabha passed on this, then again it went into Rajya Sabha. Then they have taken a one committee, select committee. They have submitted this bill to selected committee. Then they have gone through all this bill and they have given their recommendation. Again in 2016, Rajya Sabha passed this bill. After that, even Lok Sabha also, again they have approved this bill once again. Then it went into, because this is involving all the states, it's not only impacting the central government. So each and every state legislature, again, they have approved, they ratified this GST Act. So after this, then President of India given the assent to this bill. Then again, this bill went into GST Council. They have approved this bill, and there are total 3 different acts in the GST. So first one is the Central Goods and Service Tax. Next is the Integrated Goods and Service Tax, Union Territory Goods and Service Tax, Goods and Service Tax compensation to the states. So this many, all these bills are passed by both Lok Sabha and Rajya Sabha. And finally, 29th March 2017, all these bills were passed in the both the houses of parliament. So this way it's a long journey. So please remember, there are total 4 acts passed in the GST. CGST Act, IGST Act, Union Territory Goods and Service Tax Act, Goods and Service GST, compensation to the states. What is the compensation to the states? A lot of states were opposing introduction of GST. They were thinking that whatever revenue they are earning through their local VAT Act or sales tax is much higher than the GST. Because here in the GST, what happens? Whatever is the tax, if you see any GST bill, 50% of the bill amount will go to the central government as CGST and 50% to state government SGST. So they were under the impression that their share will be very less. If their share is very less, then central government has to compensate for the next 5 years or 10 years exactly. I don't remember. So that's the reason. Compensation to the states also. One more act they have got. So after all these things, 1st July 2017, GST Act came into effect. So what are the objectives of GST Act is to avoid multiple taxation. Like earlier I explained in the VAT, like multiple taxes, tax and taxes. So because of GST, what will happen? Business, the dealer, person, whoever is involving in the goods, he will claim the input tax credit. Like he might have bought some 1 lakh rupee of goods involving 18% tax. So 18,000 tax already he paid. He did some value addition and he is going to sell at 2 lakhs. So on 2 lakhs 36,000 is liable. But already 18,000 he has paid. Only tax liability is 18,000. So in that final goods, if we are buying, we are paying only 36,000, 18,000 at the basis and remaining 18,000 on the value addition. Otherwise, what will happen? 2 lakhs on 2 lakhs 36,000 plus already 1 lakh 18,000. If the dealer is not claiming that 18,000, what will happen? 36,000 plus 18,000. So total 54,000 tax one is paying on the same goods. So this multiple tax and tax is avoided because of GST. And different tax rates between different states. So that is our main advantage is whether you are buying a goods in Tamil Nadu or Andhra Pradesh or Karnataka or Rajasthan or Delhi. Rate is same for such kind of article. Whatever is 5% goods, everywhere, wherever you go, same 5% is applicable. Same 18% is applicable. Same 28% is applicable. So these multiple rates are avoided. Then input tax credit, I have explained earlier in my example. So he is liable to pay 36,000 but already paid 18,000 while buying the raw material. So that is called input tax credit. So that is major advantage of GST. Tax and tax is avoided, input tax credit, and one single tax rate for across India within that slab. So if you see go to page 192, tax structure of GST. Multi-stage tax structure. Multi-stage means it is on the value addition, not on the full cost of the goods, like I have explained. So 1 lakh is the raw material and 1 lakh is the value addition is done. So only on value addition, that person, that business entity is paying the tax, because whatever is paid on the raw materials, he is getting as the input tax credit. So it is a multi-stage tax structure. Destination-based tax structure. One more thing is tax liability is depending on the where the ultimate consumption of that goods is taking place. Like if you notice in an Amazon bill, if the goods are coming from either Bombay or Delhi, if you see the tax is IGST, Integrated General Sales. It is not the CGST and SGST, because ultimate sale is taking place in some other state. So always tax liability is depending on whether CGST or SGST, who will get the tax. It depends on the destination based tax structure. That is the one more feature of the GST. Then components of GST, there are 3 components: CGST, SGST, IGST. CGST is if it is intrastate sale takes place within the state, it is CGST plus SGST. If it is interstate sale, already when we are discussing about the CST, we told only exempted goods only CST is applicable. So rest all cases IGST is applicable. And there are 4 slabs as of now. 5%, 12%, 18%, and 28%. Like food items and most of the items also, exempted items also there. Most of the food restaurant bills and all, it will come under 5%. Goods of like common, normal, in daily usage, whatever things we use, mostly it goes under 5%. If it is like expensive items, luxury items and all, usually they charge 28%. And next is the GST Council. Please go through about the GST Council. See, who will take the decisions? Because all the states are involved and the central government is also involved. Any decision they take, it should everyone should have a right to participate in that. So what happened? That's why they constituted a GST Council. Who will be the people in this? One is Union Finance Minister. He or she will be the chairperson. Union Minister of State in charge of Revenue of Finance member. Then any other minister. Each and every state government will nominate either their finance minister or some other minister. They will be the member in this GST Council. So what the GST Council will do, GST Council will go through all the proposals, all the difficulties, and if any slab changes has to take place, if any goods is to be exempted, and if any grievances states are facing, if any troubles they are facing, all those things, and they discuss in the GST Council. So that's why after GST Council meeting, a lot of decisions will come out. Maybe these goods are charged as 5%. After GST Council decision, now no GST on these goods, or they might have increased the GST percentage. All those things, and even like turnover. Then who is applicable for GST? Like turnover, we have read in the CST or AP GST Act. If turnover is more than 50,000, is liable to register under GST Act or CST Act. Similar way, what is the turnover? So those kinds of decisions the council will take. Then page number 194, benefits of GST, benefits to trade. These are all very general topic. You all can go through it. Then go to page number 196. GSTN. It is a non-profit organization. It is nothing but how this entire GST tax system works. It is based on the GSTN. Each and every dealer will have a registration to control the registrations and also what they did, the GST registration is having the PAN number with the whatever. So one person, one company will have only one PAN. So that company may be having business in some 20 states in India. So each state will have a different registration, but every state will have registration with the company PAN number plus the suffix by the state where they are operating and what is the kind of person, he is a normal dealer or he is a company, depending on that all those codes will change. So all these things are governed by the GSTN site. This is developed by Infosys. So this is called Goods and Service Tax Network. Then let us go to page number 198. Page number 198, if you see, already we have covered. It is GST is destination based tax. Please remember this point. Then dual GST, like CGST plus SGST or integrated GST, all these things already we have covered. Even rates of GST also, there are 4 slabs that already we have covered. I think some error in this 5, 12, 18 and 28. Then after coming to the introduction of GST, it subsumed a lot of taxes. Like all state government, important one is central excise duty. In the central excise duty, there are a lot of duties of excise, additional duties of excise, special additional duties of customs, then service tax. These are all important laws. These are all replaced by the GST. Now there is no separate service tax. If you see, there used to be service taxes and services. So state VAT Act or GST only covers about the goods. Service tax used to cover about the services. So now everything is taken care by the GST Act. Then what are all the exempted products? Already we have discussed in detail. Then same thing is repeated in page number 200 also, GSTL. So with this, I think second part 2 is completed. Any further explanation, clarification, and like anything is to be repeated once again?
No, madam. Thank you.
Then let us go to income tax. Last time we have covered up to house property. After that, business or profession, capital gains and all not required. Much importance is not given in terms of questions, quantum of marks. Then page number 129. So those 4 topics, let us have a look at it. Page 129. Law and procedure for assessment. So in that laws and procedures for assessment, what is assessment? Whatever is assessing any value, that is called assessment. And assessing, these are all basic definition already we have seen. Who is liable to pay tax? Any person, association of persons, HUF, company. So all these persons are liable to pay income tax. And what are all the heads of income? So there are 5 heads of income already. We have discussed a few heads of income. And types of assessment. So assessment means when a person is liable to assess his income for the payment of income tax. First is the self-assessment. Like a lot of us, salaried people and all, they do self-assessment. So one will assess whatever is the income as per salary, whatever is my other source of income, if I'm having any income from capital gains. So all these things, self-assessment, he or she will do and will assess what is the income tax liable to pay, and they discharge the liability accordingly and file the income tax return. That is called the self-assessment. So, one must be entering into that, login into their income tax portal and submit the return. That is the self-assessment. In case of self-assessment, what the income tax department will do, they acknowledge your income tax return, and after some time, they go through your return, and if they see there is no problem in that, they complete the assessment. So in that case, if you are refundable, any amount is refundable to you, they will refund that amount. If any amount, there is no problem, whatever you have filed, and simply they dispose that return. So in that case, it is very simple. But sometimes what happen, he may be having a doubt on your assessment. Some portion of IT returns, maybe some 3 to 5% of the income tax returns, whatever filed by us, they take for further scrutiny. They may be having some doubt, maybe huge refund is claimed by the assessee. Then they will have a suspicion, or it may not be a suspicion, just to ensure that your claim is correct. Then they wanted to refund. In that case, what they will give the notice for scrutiny assessment. In that case, you have to submit all your, whatever way you have done the assessment, you have to submit all the evidence. If you are claiming excessive loss, maybe some loss under the house property. Nobody is staying in my house the last 1 year, though this house is a let out property. I'm not able to get any rent. So you have to show the sufficient evidence. In that case, they will withdraw that. Otherwise, maybe they recalculate your income tax liability and they may ask you to pay the additional income tax. So all those cases will come as scrutiny assessment. So there are a lot of sections, but understanding all those implications and getting into depth may be difficult at your end. When one person will receive a notice, usually a lot of transactions, what will happen? A lot of people, they may not be filing their income tax returns, simply ignoring how income tax fellow will know about my transactions and all. Now everything is very simple for them. So whatever transactions, whatever cash transactions happening in our account, whatever deposits and all, they will take it, and accordingly, if this person is having huge turnover in his bank account, but he is not filing the income tax return. So that is the first way. And sometimes what happens, maybe you have filed your excuse me, income tax return, and the income tax officer has given you a notice, but you are not responding to that notice, or even you are not complying their directions. So all these cases, they pass the assessment also. You need to pay this much tax liability. Then what happens? Even sometimes what happens, some incomes you may not have disclosed also. Like some additional expenditure is there in your income bank account, like you went on some foreign trip, you are not able to explain that. So there is no income for you, but you bought some expensive items, like maybe expensive. So unexplained expenses also in your account, they will treat it as income and they will pass a assessment. This much you are liable to pay the income tax. So all these cases will come under best judgment assessment under section 144. Sometimes reassessment also will take place. Like maybe after a few years, they may get some doubt. In that case, they may reopen the even previous assessment years filed income tax returns also. Sometimes what happens, there may be clubbing of transactions between person A and person B. So in that case also what they do the precautionary assessment. Then go to page number 133. Deductions under chapter 6A of the Act. One must be knowing all these things, whoever is filing income tax return. Up to 1.5 lakhs, one can claim the deduction under chapter 6A. Like whatever one is taking the mutual funds, LIC policies, depositing in provident fund, the tuition fee, housing loan principal repayment, all those things are covered under this. Actually, your book is not having lot of latest things. Then what is permanent account number? Because these are very small, these things can write and can get good score. PAN is having a 10-digit alphanumerical number. Then what is TDS? Tax deduction source. Like if some person is remitting money to some other person because of a contract, then he has to deduct tax at the source. So that what will happen? He is deducting the tax and he is filing the return. So income tax authority will have a details about how much that person remitted to other person in terms of contract. So whether when this person, whether he is filing his income tax return or not, so he can catch hold of this other person. So that is the TDS, advance tax. You are liable to pay some 10 lakhs tax in a year. Government is not waiting till the financial year ending. So on advance tax every 3 months, whatever is you are liable to pay tax, some portion of tax, maybe 75% of tax, you can remit in advance. So if you are not paying advance tax also, you are liable to pay interest on that. That's why Jivita madam, what is this thing? I didn't understand your query.
Well, you told our book is not having latest information, right? Where we can
That is
refer.
what limit under chapter 6A is 80C is 1,50,000.
Okay. So, is there any website or somewhere we can refer?
The website is income tax website. See, these are all points are valid. Only thing is monetary limit is 1,50,000. Then additional benefit of 50,000 on national pension scheme. Page number 133. So those things suggest you can write the latest things.
Oh, okay. Okay, thank you.
Then one more thing, double taxation avoidance relief. What happens? Maybe some people getting the remuneration from some other country by maybe some visiting faculty, all those things. So already whatever income they are receiving in that country, already that is deducted, tax is deducted. So if he is declaring his income tax in India, he will declare that as his income. But what happens, already tax is paid in that country. If he is paying, again it will become double taxation. So already we have agreements with a lot of countries. So in that case, if already tax is remitted in some foreign income, again he need not pay here. So that is double taxation avoidance relief. Next is page number 137, remedies. So what are all the remedies? Like it is a grievance. You have filed your income tax return. Assessing officer called you and told, no, you have not declared this income, or whatever exemption you have taken is not applicable. So you need to pay some additional 50,000 tax on that. So then in that case, what is to be done? You can still appeal. You can go to the next level, his higher officer, and you can put your appeal in front of him. Like this way, taxation law is interpreted by assessing officer, and I am interpreting in this way. And these are all the facts. You please relook into it. So sometimes these are all, many of the times, these are all the how you interpret the laws. So interpretation of assessing officer may be a different, maybe his boss may be different. So we always have the appeal option. So it is the right of an assessee. So there are 4 types of appeals. First appeal. So assessing officer boss is commissioner. So there is a commissioner of appeals. So first appeal will go to him. If you are not satisfied, if the commissioner of appeals also will give ruling against you, no, you have to deposit this tax, you can go to the second appeal. Is the CIT appeals, commissioner of appellate tribunal. And then next is the High Court, and even Supreme Court also it will go. Usually companies and all, they will go because their liability or their tax liability will be huge. So depending on the quantum of money, all these things, they go to till even Supreme Court also. These are all the appeals. So when one can file the appeal to the Commissioner of Appeals is within 30 days once assessing officer passes any order. If you have any grievance, you can go to him. So what are all the appealable orders is generally whatever orders assessing officer passes. Then sometimes what happens, orders passed in reassessment proceedings. One more time they reopen your assessment, and that time if they quantify some tax liable in those cases also, a protective assessment order. So to protect their interest also, they pass the assessment orders. So these cases one can do. When one cannot go to appeal means you have paid the tax, but you paid delay. So interest is payable. In that case, you cannot go for appeal. No, I don't wanted to pay interest and all. So these are majority is interest only. So in case of interest, you cannot go for non-appeal appeal. So time limit for filing an appeal is 30 days from the receipt of notice. Sometimes if any delay happens because of some reasons also, one can beyond 30 days also, one can go for filing the appeal. Procedure for appeal is it should be it must be in writing and it must be given to CITA with all the whenever you receive the notice within that period. Then appeal order, sometimes orally they tell but they don't pass. In that case also you cannot go for appeal. So it must be in the form of appeal order. These are all very in-depth points. Please see what are all the questions asked in that. So always the Commissioner of IT Appeals is the first appellate authority. After that only it goes to ITAT. Then it will go to High Court and Supreme Court. So what are all the appealable orders, non-appealable orders also, please remember. Next topic in page 143 also, it is similar to previous discussion in page 139 and 140. It is a mostly repetitive kind of thing. So within 30 days you have to go. Then if any condonation of the delay also. Normal appeal should be in 30 days, but appeal before ITAT is within 60 days of date of communication of order received. Then monetary limit for appeals to ITAT by department. Even departmental, it is not only the assessee. Even department also will go. If it is not in favor of them, they will go to their next officer also. If it is in favor of assessee and they are losing their revenue, so they will also go to higher authority. So it is not the question that always appeals, only assessee will go to the appeal. No. Both the parties, any of the party can go to the appeal. Then page 146. Penalties and prosecutions. So when the penalties will be levied on any person? First is the default of tax. Please remember, very easy. And advance tax. If tax liability is huge, one is liable to pay the tax in advance. If that person fails to pay tax in advance, also penalty will be levied. And income tax authority is issued the notice and he is not responded. Then also penalty is there. And some concealment of income details are happened. So these are all very common, just if you think about the income tax, when a person can levy penalty, if he is losing his tax, so what are all the grounds one can lose the tax? If you are not depositing tax on time, or if you are concealing any of your income, or if you are not maintaining your books of accounts properly, or you are not allowing to audit, or you are not getting audited also. Then if any legal obligation is there, you are not giving any reply to that. Then you are not providing any information related to your business or profession. Or if you are discontinued the business, but you fail to give the notice to department. All those cases, even if employer failed to deduct the taxes, or if he has already deducted TDS but is not remitting. So all these cases also will attract the penalties. So these are all very, if you are not allowing the inspector to visit, inspect your books of accounts, anything, these are all, it appears very small reasons, but all these things will be attracting the penalties. What are all the punishable offences? Page number 148. Removal, parting with otherwise dealing with the books of accounts, fraudulent transfer of properties to avoid the recovery of taxes, how previously we discussed. If a dealer fails to pay the tax, what will happen? Liquidator will liquidate the assets and he will pay the tax to government. So similar way, assessee has fraudulently transferred assets to other person, so that liquidator cannot liquidate the assets and can pay the taxes. So these are all punishable offenses. Like even any failure to provide taxes or taxes are deducted, not remitting, all these are all punishable offenses. Whatever is there in the penalties, most of the things will come here also.
Excuse me, madam. I have a question. The punishment would be penalty, right? Penalty or fine. If the person is not able to pay the penalty or fine, his property or his asset or it's no more or it's not available or no more. So how it will be? The next step will be taken.
In that case, what they will do, that the person is dealing in some business with some other organization and all. Income tax government authority will write a letter to that company, sir. If you are liable to pay anything to him, please don't pay. You remit that amount to income tax department. So they will see the whatever is the possibilities and all, how they can recover. If
they try to seize the property or assets.
that and all they will do. If that is what if fraudulently they have done transferring the assets to wife or some other people in the family, so that they said I don't have any assets and all. So these are all proven transactions that just to avoid the tax payment, assessee has done all these things. So those cases also, it is again they will take it back and they will do that because it's a deemed property only. Again, so his own property only. So all these things they will consider it. Or they if they don't have any properties and all, if they file a liquidation, all those things, that is extreme. But in normal cases and all, they get us to the companies and all. If you're liable to pay any amount to them, please remit it to income tax department.
In this case, if there is no possibility of a recovery of money or property from income tax department, then what kind of punishment you need to face? Whether it be
maybe even imprisonment also.
Okay, so it would be imprisonment.
Even imprisonment also.
Okay, thanks for clarifying, ma'am.
So most of the things are covered and not in depth, but at least for your understanding. So that with this understanding, if you read, at least my intention is that I think most of the things are covered. So if any specific these things is there, just go through that. If you have any queries, cumulatively, like just you please note it down, and a total maybe 1 hour session some other day we can take it. If you're having any difficulty in practical questions, understanding that, answering that. So specifically for all topics, if you give note it down and if you can pass it on to me, maybe some 1 hour time we can spend and further we can discuss about it.
Sure, ma'am. We will check with Kamakshinadan. If you have any questions or doubts, we will collect it in a bunch and get back to you with the time so that you can help us. Thank you so much.
I think we have done mostly. Only some portion, like after house property, that 3 more are there. I think you can go through that also, business or profession, capital gains, then other sources. Okay then, I think we can end up this meeting.
Yeah. Hello, madam. Sorry, I just reached home. I was outside, so Dinesh was trying to record this.
Okay.
The team has understood the concepts of whatever you have thought now. Okay, so I think this would be really helpful, madam. So I'm planning to consolidate, that one, the earlier one, and this one, and I will, planning to upload in YouTube. So all the sessions have been complete, or what is the pending, madam?
Only thing is business or profession, capital gains, and other sources. That assessment, that also I think much marks are not there. So you told that that is not
Okay.
required to cover. Otherwise, everything is covered.
Okay, madam. So the case studies will you be able to cover, or that we
Sir,
can?
if any specific questions are there, very important things, maybe some 10 or 15 questions, just you note it down from all the topics. So just you please go through it. Maybe some other session next week or next week we can plan just 1 hour session.
Okay. Good. Yeah, sure. Thank you, madam. Thanks for your efforts. Really have spent, nearly last week 2 hours, and this week, 1.5 hours, 3.5 hours.
Not an issue, sir. I think always whatever we know, telling to others is always win and win. For me also, it is a very good exposure. After a long time, I was also referring and taking the class. It's a good opportunity for me also.
Excellent, madam.
Thank you.
Yeah. Thank you so much, madam. Thank you. Yeah, feel free to drop.
Thank you, sir. Thank you so much, sir. Thanks, ma'am.
Hello, Kamakshi. You are asking about the question paper discussion.
Yeah. The case studies. Not the question paper. The case. In each 5-year question paper, part C questions are there, right? Okay. So if she could able to do that, okay. Or otherwise, next week I am also learning the same thing, so I could also cover that. Probably just ask her to have a look at it. If it is possible according to sections, we can, because those are all case studies, right? Those are really required, from financial expert point of view. If possible, they can, you can plan it, Rajkumar.
Okay, definitely. Just I'll ask her to check the all last 10 years question paper, and part C needs to be covered. And
part C alone.
Yeah.
No, not part A, part B, part C alone.
Yeah.
Part C is our question paper, that cases, right? So the cases alone. At
Yeah.
least a 5-year question paper for 1 hour is also okay.
Yeah. Or it might be repeated questions, might be there. We can cover
we can skip
in
that.
1.5 hour to 1.5 hour.
Yes,
we can cover.
that is right.
Yeah, I'll ask her to check all the questions